Dividend decisions are the third type of decisions in financial management. In the first decision, that is investment decision, you have decided that yes, the business needs money. In the second decision, that is financing decision, you have decided whether to raise the money through debt or through equity. And after you have invested the money, the business generates profits. In the third decision, that is dividend decision, you need to decide what to do with the profits. Should the business distribute the profits as dividends to the shareholders, or should the business retain the profits to reinvest it somewhere or keep it as reserves? What are some of the factors affecting dividend decisions? Amount of earnings, because dividends depend on current and past earnings. So higher earnings will allow for higher dividends. Stability of earnings. Companies with stable earnings year on year are better positioned to declare higher dividends. Stability of dividends. As a policy or as an obligation, some firms may need to maintain a steady dividend per share every year, depending on the sustained earning potential of the company. In such cases, companies will declare some dividend every year. Growth opportunities. Companies with better growth prospects and investment opportunities may retain more earnings because reinvesting the profits will lead to future growth and will eventually increase the market value of the shares, increasing shareholder wealth. Cash flow position, because adequate cash availability is essential for dividend payments, even if the company is profitable. Because if the profits are notional but not received in cash, then dividends cannot be paid out. Shareholders' preference. Management will consider the shareholders' desire for dividends or their desire for reinvestment in growth and decide whether to pay out dividends accordingly. Taxation policy. Higher taxes on dividends may lead to lower payouts and vice versa. So the tax policy of the government at that time will affect the decision on whether distributing dividends is better or retaining the earnings is better. Stock market reaction. Increases in dividends often boost stock prices, while decreases in dividends can negatively affect the stock prices. So dividend declaration can be done on the basis of whether the company wants to affect the share prices positively or negatively for any reason. Capital market access. Large companies with easier access to capital, such as Reliance, may pay higher dividends as compared to smaller firms, because for larger firms it is always easier to raise equity whenever they need more funds, and there is no need for them to retain the profits. Whereas smaller companies may prefer to retain the earnings because raising more funds through equity is difficult for them. Legal constraints. Some companies must adhere to legal restrictions on dividend payouts as specified in applicable laws, and some companies may be required to pay dividends by law. And finally, contractual constraints. Suppose a company has taken a loan, then the loan agreement may restrict dividend payments till the principal and interest obligations are met. So in such situations, companies cannot declare dividends. So these are the factors affecting dividend decisions.